our segment. Before we hop into it, we always want to cover our safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, Tim Driver, and James Porter. This is not investment advice or anything like that, but we're going to give you the best and latest information that we can. And we hope you enjoy it, and hopefully that we get a lot of Q&A as well. First things first, on the macro side, this is a chart that we have not discussed yet, but we've talked about the essence of this chart in prior Cup of Joes. I think it's a very important topic, and it's pretty all-encompassing. What we're looking at, there's a lot within this chart, but I'll break down what we're ultimately seeing here. This is looking at the CapEx, which is capital expenditures of commodity producers. So commodities across energy, metals, and agriculture. And what we're looking at specifically is going to be North America, so US, Canadian Stock Exchange information. And what we're ultimately seeing is this is the amount of money that they're spending to further productive assets. So new mines, new oil fields, things like that. You can see that as we look back over the last decade, 2007, 2008, that was a big commodity bull cycle. 2011 to 2014, big commodity bull cycle. That would have been some of the times where we saw natural gas prices and crude oil prices up around the levels in which we are today. Now, what's interesting is from a capital expenditure standpoint, or said a different way, from an investment standpoint, commodity producers are spending far less money now on a relative basis than they were during those prior two commodity booms. Why is that important? Well, as we think about bottlenecks, shortages that we've ultimately seen over the last 2 years, it's looking like those risks are very much so going to be on the table as we roll forward through time. I'm not necessarily saying this is going to be a 6-month issue or a 12-month issue. This is probably going to be something that's far more structural, long-term, maybe 5 years, 10 years down the road. But certainly is a bit of an iceberg coming our way, because if we don't have companies and investment firms reinvesting in productive assets, whether it's copper for an energy or for a power grid, or grain for producing food, these things can eventually run out, and the shortage that we've seen over the last 2 years could continue to be more of a pervasive issue. So I thought this is a pretty interesting chart. It's not my own. It's of a company called Crescat Capital. But I thought it was a very good all-encompassing view across some of the topics that we've been discussing, which is really a lack of investment into the commodity production side of the equation. So until or unless this starts to turn higher, it looks like we might have some bumps down the road as we look forward several years into the future. Flipping over to the chart that I always like to reference, because I think it tells a great story from a lot of different angles: a manufacturing angle, a geopolitical angle. Again, we're looking top to bottom, alphabetical order, left to right, October 2021 through September of 2022. Very easily, you can quickly pick up that things are moving from deep green territory to yellow to red, seeing a lot more red in this month's PMI data. So that anything above 50 is going to be suggestive of growth. Anything below 50 is year-over-year weakness. A couple quick ones that I want to point out. Obviously, as you go down about 5 to 10 down, you're going to see the European region. A lot of the European regions are continuing to see softness. And some of those regions, the big major ones, France and Germany, have actually gone into red territory. So whatever we're experiencing here in the United States, it's certainly incrementally worse within Europe. One of the big reasons why I would say that's the case is due to lack of energy security. We've talked about that for a number of consecutive podcasts. Working our way down the list, I do want to provide a small semblance of optimism within the United States and North America. You look at the United States, 3 from the bottom. The PMI number came in at 52, which, all things being equal, is kind of a bright spot on a global basis. I would say that our energy security, while we do have inflation, it's certainly much more muted than some of the emerging market economies. And as I survey the landscape of our customer base, I would say that the outlook, at least for the next 6 to 12 months, still looks okay. It doesn't look phenomenal, but it looks okay. So on a relative basis, I would say it's certainly the case that the U.S. is one of the bright spots as we look out over the global landscape. It is worth noting that China continues to struggle a bit. I continue to kind of kick this can down the road, which is I continue to think that it's more of a when, not an if, China lifts some of its zero COVID policies. but they just haven't done so yet. So they continue to struggle on that side of things. But the overarching theme here is keep in mind, some of my slides that are upcoming are going to look fairly negative, but I want to reinforce the statement that the U.S. and North America generally, on a relative basis, looks okay for now.
Hey, Nick, I can't help but notice India. I know we mentioned it a few podcasts ago, episodes ago, I should say. It looks like it's remaining strong, and there was some significance there, if I recall, that you noted.
Yeah, and I think I got to be somewhat careful in this, but again, this is my personal opinion. It seems like there's a little bit of an element, and I love that we have Tim and James on, because we're going to be talking about not just nearshoring, but maybe even this concept of friend shoring, or the idea that some allegiances and allies are shifting. And I think that's certainly the case with India. And what I mean by that is India seems as though they're kind of an innocent bystanders, just kind of staying on the sidelines, not making a whole lot of noise through all of this fuss over the last 6 to 12 months. But there's certainly some evidence that they are somewhat of a beneficiary of the fact that as energy and commodities aren't going into Europe, perhaps there's an argument to be made that they're actually finding their way into India, and maybe even they're finding their way into India at a discounted price. So in the case of like Russian crude oil, if you're willing and able to go out and buy Russian crude oil, you can probably get it for $25 to $30 below the benchmark price. So this may be a situation whereby, India, being that quiet, innocent bystander, is actually getting some benefits of the turbulence that's happening in other parts of the world. So yeah, fair to point out, they're certainly the bright spot within the global manufacturing space. Continuing on to kind of broad economic indicators, this is one I don't believe we've looked at in the past, but this is called the Leading Economic Indicator Index. The blue line is going to be looking at it on a year-over-year basis. I apologize. The white line is looking at it on a year-over-year basis. The blue line is going to be looking at the last 6 months and then annualizing it. You can see at the blue line, so the last 6 months is inherently much weaker than the year-over-year data. And that's really just a suggestion that the last 6 months within the economy have been struggling more so than the prior 12-month period. It is worth noting that you can see that pretty visually as we go back to 2000. Anytime the leading economic indicator gets down into this type of price range, it has precluded or coincided with a recession. We go back to 2020, go back to 2008, 2009, and then the dot-com bubble. Each of these instances, we saw a recession. Now, I'm not trying to make the podcast about myself, but I continue to argue that we are perhaps already in a recessionary landscape, which is why I made the bet in the first place that I would cut my hair if and when we get an official recession. Unfortunately, my brother reminded me about a week ago. He said, I don't know why you made this bet, because the National Bureau of Economic Research typically doesn't even declare the recession until a year after it occurs. That, for instance, the last time we had a recession, it wasn't until a year after that they looked back at the situation and said, oh yeah, that situation back then, that was a recession. So unfortunately, it's not looking great for the haircutting in the next couple months, unless the Buckeyes slip up and fall to Penn State or Michigan. It's you might have to deal with this situation for a little while longer. I apologize.
I'm convinced you keep putting in these charts just to push it, so something will happen. So
I'm hoping somebody from that council is listening to Cup of Joe. I'm not sure we're getting to their ears though. So as we look at the current environment with regards to the Federal Reserve and their rate hiking cycle, I know we've talked about this in past Cup of Joes. One indicator that some hedge funds like to look at is the 2-year Treasury yield. We can see it here visually. When you compare the 2-year Treasury to the Fed funds rate, which is ultimately the rate that the Fed is trying to manage, and right now they're managing it higher, you can actually see that the 2-year Treasury tends to lead what the Federal Reserve ultimately does. You can see it on the way up, and you can actually see it on the way down as well, that the 2-year yield tends to be the leading indicator for where the Fed ultimately goes. Why is that important? Well, if we look at the spread right now between where the 2-year yield currently sits and where the Federal Reserve target rate is, it's about 100 basis points. And the idea there is the market is basically saying they believe Jay Powell and the central bankers are going to take interest rates another 100 basis points higher. before they maybe pause or slow down or take some assessment of the economy. That's just a snapshot in time. That's basically what they're saying. Does the Fed ultimately get all the way up there? We'll have to see. There are beginning to be some cracks in the global economy, and I would say they are stemming by way of the hawkish Fed policy that's coming out of the United States. But one of the things that the Fed is probably excited about, which is a weird thing to be excited about, is the number of job openings that are currently out there. It's still extremely elevated, and you can see that here in this 5-year chart. It peaked out right around just below 12 million people. So again, there were only 6 million people looking for jobs. There were 12 million jobs open. The Fed didn't like that. They basically said the market is so insanely tight. People are still hiring in large quantities, which ultimately can drive wage inflation. We need to kind of damage the jobs market in order to calm down inflation, calm down wage inflation. And what we got this week was, for them, a bit of encouragement, which unfortunately is kind of bad news. About 1 million job openings have come off the docket. So we're now close to about 10 million job openings. It's still very elevated relative to history, but that move is certainly what the Fed is trying to achieve, is bring the number of job openings, bring the job market a little bit softer so that people feel a little less enthusiastic, stop spending money quite so much. So it's a little perverse what their goal ultimately is, but that's unfortunately the pain that they reference when they talk about trying to calm market conditions down.